Hello once again, options traders, and good morning to everyone. And I got a special request from one of the traders in our group asking about a broken wing iron condor. Now, I'm pretty sure he meant a broken wing short iron condor, so that's how I'm going to do this video. And the reason I say that is that the short iron condor is probably by far and away the more popular strategy. It does not mean it's better, but that's why I have a feeling he was asking about the short iron. But it's a big topic of confusion. I even have books written by professionals who confuse these two. So we're going to start off with a little tour of the standard condors and the short iron condors so that you get them straight. And then we'll take a look at the broken wing versions and find out why you might be using these instead. So before we get started, please be sure to click like. It goes a long way in promoting the channel and would be greatly appreciated. So let's start with the condor. The condor is one of many what are called wing spreads, and it's very similar to a butterfly, just that it's going to have a flattened portion across the center, as you'll see in a moment. But you're going to use either all calls or all puts, at least for the standard condor. For this video, I'm just going to stick with the call version. So it's probably easiest, at least for the sake of time, to just show a quick example. And what you're going to do is perhaps buy a strike. Pick one on the board. Let's say we pick the 95 call. And then you're going to sell a higher strike call in the same number. So if you bought one, you would sell one. And then you're going to sell another strike at yet a higher number. So maybe we sell the 105 call, and then you will buy yet an even higher strike. So notice that they are all in equal numbers. We are using one contract. You could use 2, 5, 10, whatever number you want, as long as these numbers are equal. They are also spaced equally. I've gone from 95 to 100, 105, 110. They're spaced by 5. You could use other numbers. You could use 2.5, 5s, 10s. And there are reasons why we might choose one of these different spacings. I won't go into that now. But they have to be equally spaced, at least for the basic versions. And in this example, we would say that you are long the 95, 100, 105, 110 Condor. Yes, they have very long names, but we're just simply picking off the strikes in order. Now this is a debit spread, so that's why it's a long Condor. So if we put this trade on in our account, this is what we would get for a risk graph. And as I talk about in nearly every single slide with a risk graph, you always get a bend at your strikes. So that's a nice little check also to make sure that you're looking at the right strategy. Maybe if you're using something like Think or Swim in the Analyze tab. So notice that we have a bend at 95. That was our long call. We have a bend right here at 100. We have another bend at 105. That's the second short call. And then finally we have a bend up here at 110. So the standard condor is a neutral strategy. You can see that we want the stock to stay in a fairly neutral range. However, if it rises too far out this way, we end up in losses, albeit limited. Or if it falls too far, we end up with losses, the same number. So you can see that we lose 2 if the stock falls too far or if it rises too far. Now, a little side note, a lot of new traders think that the reason you use a strategy like this is because you think the stock is going to sit still. That is never a good reason for using any strategy, just because of what you think. The reason for using this strategy, or any strategy for that matter, is because you have some type of an edge, or at least a theoretical one. So in the case of a condor, synthetically this is the same as a wider strike strangle, the 95-110, combined with a short strangle, the 100-105. So if the implied volatility on the short strangle were greater than that of the long, that would be a good reason for using this condor. But again, that's a little bit of a side note, but I like to point that out because too many times traders think that the reason for putting on a strategy is just because of what you think. But the analogy that I've used so many times, if you think a particular team is going to win a football game, that has really nothing to do with it if Vegas has a 25-point spread against that team. So you wouldn't take that bet. In fact, you'd be inclined to bet on the opposing team. And so that's the same idea that's going on here. You cannot put on any strategy just because of what you think. You've got to look for a theoretical edge. Okay, so that's the standard Condor. What is an iron Condor? Well, anytime you see the word iron, it's a combination of calls and puts. So in the first example, I said it was either all calls or all puts. Notice now that we are using a mixture, going to be a combination of them. We're going to put the longs in the center while the shorts will be in the wings. So for instance, maybe we sell the 95 put, we buy the 100 put, we buy the 105 call, and then we sell the 110 call. So first thing, notice that we are using the same numbers, one contract for each, at least for this example. We are using the same strikes, 95, 100, 105, 110. But notice that we have the puts on the low side, 95 and 100, and we're using the calls on the high side. If we switch them, that's actually what's called a gut iron butterfly, or a gut iron condor in this case. And there's reasons why we might use that. But this is the standard iron condor. So in this case, we would say that you are long the 95, 100, 105, 110 iron condor. And then as a trader, you would just know that unless it was specified as being a gut iron, that the puts are on the low side and the calls are on the high side. So if we put this trade on in our account, this is what we would get. So in a sense, it's a little bit more like a straddle or a strangle, where we're looking for either a big move up, this is what pushes us up into maximum gain, or for a big move down, which again will put you up into maximum gain, same gain on both wings. But now if the stock sits quiet in the center, now you lose. So it's really just the opposite of the standard condor that we saw. So this is why most traders get this confused. They will talk about an iron condor, which this is your risk graph, but they really want the first risk graph that we saw of a standard condor. They just want to use the iron version. So what is a short iron version? Well, it should be just the inverse of this. Okay, so the short iron condor is again just the short side of the iron condor. If you put on an iron condor, the person on the other side of the trade from you has the short iron. Or if you put on the short iron, the person on the other side has the standard iron condor. So it will be a credit trade, this short iron. Don't let that fool you. Remember, there's nothing special about a credit trade. You are not getting paid for it. By the time you check out at the broker's platform there and actually place the trade, it will be a debit because of the margin requirements. But just the combination of the options by themselves does result in a credit. So it's again going to be opposite. The shorts will be in the center while the longs are the wings. So let's say that you buy the 95 put, you sell the 100 put, you sell the 105 call, and then buy the 110 call. So as before, same number of contracts, spaced equally, in this case by fives. Puts are on the low side, calls on the high side. But I've just flipped the colors. In the iron version, we put the greens or the long in the center, and the reds or the shorts were on the wings. We've just flipped it. Again, it's the trader on the opposite side. So here we would say that you are short the 95, 100, 105, 110 iron condor. It's a short iron condor, and if we put this trade on, this is what it would look like. Exactly like the condor. And this is why I said I think this trader was talking about the short iron condor, because this is a really popular trade among traders, these condors. And so once they learn about the iron versions, I'm just guessing this is probably what he's talking about. But regardless of whether you're using a short iron or a standard iron, and there's butterflies and condor versions of each, the broken wings are a completely different category. They're related, but it's really a different category. So they just call them broken wing something, broken wing butterflies, broken wing condors, and things like that. So here, the broken wing condors and the butterflies are identical ideas. But what you're going to do to make it different is you will sell more of these short options at one strike, not at both of those shorts. It will just be at one of them. You will buy an equal number of longs to be delta neutral. So for example, let's say that you buy one 95 put, you sell one 100 put, But now you're going to sell 2 of the 105 calls and therefore buy 2 of the 110s. So we need to buy 2 here to make this delta neutral. So if we put this trade on, this is the risk graph you're going to see. You see how it's now asymmetric? This is the broken wing. So the first thing you can see, at least in the way we've set this one up, is that it has a bearish bias. If you had to pick a direction for it to move, we would rather see it move lower than higher because it's just going to put you in a less of a loss. But it is a neutral strategy, but again, it has a slight lean to the bearish side. But what's causing this broken wing to occur? Well, notice on the left-hand side we have delta 1, and that's because we bought and sold 1 put. Here's the sale of the 1 put, delta 1. Here's the purchase of the 95 put that makes us 0. But as we come up here, as the stock moves here, we eventually hit the 105 strike, and this is a short call. But remember, it's not short 1, it's short 2. So this delta over here is not -1, it's -2. So it's actually a steeper slope over here. And that means as you move between 105 and 110, you have further to fall because you're falling at a faster rate. And that's what's causing this broken wing. So to see it in comparison, it's a little hard to see that these are different slopes. But if we overlay the standard Condor, now you can see there's delta -1. And so you can see that it's not as steep as this in blue. So even though the trade in red bends at 110 and the trade in blue bends at 110, because the trade in blue has -200 deltas, it falls faster. And that means by the time it hits 110, it's dug a deeper hole. And that's what's creating this broken wing over here. So again, there's a lot of different reasons why we might choose a broken wing at the onset. But from a trading perspective, there are probably more important reasons. Now, I've talked about this before, whether you're using condors or butterflies. I just happen to have the slides on the butterfly, so I'm going to use them. Here is a butterfly, but you can also have smaller or embedded butterflies in here. So notice that in black, we have the 100, 110, 120 butterfly. But I also have the 100, 105, 110 butterfly in here. I have 2 of the 105, 110, 115s, and then I have 1 of the 110, 115, 120s. There are actually 4 smaller butterflies inside of this one. And so this is where most traders make their mistakes with butterflies. They trade this one in black, they just manage it, they either win or they lose. But there's other ones in here that could be winners in the interim. So if this blue butterfly right here, the 100, 105, 110, is maxed out, or at least very close, why not close it? It's only presenting a danger to you now. It can't really be worth much more, but it could certainly lose more. Let's close it. Well, when you close it, you're going to start legging into broken wing butterflies or potentially standard condors or broken wing condors. And this is probably the primary reason for understanding the broken wings, is that if you put on a condor or a butterfly, there are smaller versions embedded in there. And all of these must be managed. And so as you start peeling these away, depending on which ones are becoming more favorable, you can end up with broken wing versions. And of course, we can go back and rebalance them with butterflies or condors. We're going to buy them when they're cheap. We're going to sell them when they're expensive. But what we're not going to do is just buy this one butterfly here in black and just hope that the stock stays still. Now, sometimes traders have asked, are these really the same? Do they really add up to this one in black? Well, if we go to a pricing model, here is the 100, 110, 120 butterfly in black. Pricing model says it's worth $3.86. If we look at the blue butterfly right here, pricing model says it's worth 94 cents. The 2 butterflies in red are worth $1.03 each, and the butterfly in green is worth 86 cents. So if you add up these smaller butterflies, look at that, equal 386, exactly the price of the butterfly in black. So this is why you've got to manage each of these. You actually have far more trades, far more potentially profitable trades that you're not even seeing. And the way that you manage these is to realize you're probably going to be stepping into some broken wing versions. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the YouTube channel, Options A to Z Facebook Trading Group, and you can find a link in the description below.